Thank you so much. It's really lovely to be here. I do have a slide deck that I would like to share. So if you just give me a moment I think the host needs to enable sharing so that I might share my slide deck. Good morning, and thank you so much for this opportunity to come speak with you today. My name is Tania Zeigler, and I lead the global benchmarking activity at the Cambridge Center for Alternative Finance. The Cambridge Center for Alternative Finance is housed at the University of Cambridge Judge Business School, and we're a research center that's dedicated at looking at the evolutions of financial technology and how financial technology is really shaping digital financial services. Last year, in response to the COVID-19 pandemic, we conducted a study with the World Economic Forum and the World Bank to try to understand what the impact of this pandemic has been on the global ecosystem, but also quite critically on certain key jurisdictions and key markets, of which India is quite critical. So I'm going to spend some time today walking you through our entire study, looking at the global perspective, but then also really honing in on some key figures that we've derived from the participants that responded in India as well. And I think that should allow us to really get a good overview of kind of what is happening with respect to financial technology as a result of the COVID-19 pandemic, how firms have had to evolve their products and services, how they've had to engage with regulators and those that supervise them, and certainly what the impact has been for those firms with respect to their market performance as well as operational activities as well. So with this in mind, this study really allows us to understand, how the industry is adapting, reacting, and enduring since the pandemic. We based this study on firm-level responses that came from nearly 1,400 financial technology firms from over 160 countries and jurisdictions. 22% of the surveyed respondents actually are headquartered or operational in Europe. This is then followed by the Asia Pacific region with 21% of the respondents, 14% coming from Latin America and the Caribbean, 10% from Sub-Saharan Africa, and then just over 5% from the Middle East and North Africa. Around 43% of all of the respondents that participated in this study actually reported having operations in one or more countries or jurisdictions. And on average, when we see these multi-country, these multi-jurisdictional firms, they tend to be operating in anywhere from 4 to 5 additional countries in addition to their headquarter country. When we go to the next slide, sorry, I didn't realize I was controlling my own deck. If we just hone in on India, what we were very pleased to see was that actually this was the third largest country in our study after the United States and the United Kingdom. We received responses from 142 firms that had operations in India, and then we noted that 83 of those firms had their primary headquarter within India. We also noted that there's a very big prevalence towards firms that are retail facing, and we're going to talk about what we mean by retail facing in just a moment. But as you can see from this map, we really are now thinking of fintech as a true global phenomena. Oftentimes, much of the dialogue around fintech has been very isolated to Europe or isolated to the United Kingdom and the United States. Actually, what our study has found, and a number of studies have found as well, is that India is a very quickly growing market, one that is quite substantive, and has had a very big role in this study here as well. So if we look at the kind of verticals that we're looking at within this study, we covered 13 different, what we're referring to as primary verticals. And as you can see, we saw a lot of these coming from digital lending. This is then followed by payments and by digital capital raising. Not surprisingly, these top 3 verticals are also the top 3 verticals that we saw coming from India as well. So in India, it was 39% of those respondents were digital lending, 18% were capital raising, 17% were digital payments. when we look at just these three verticals, globally, this sample is over 50%. In India, this is over 70%. And though within each of these verticals, we see ample representation from each jurisdiction, we actually note that around 30% of all digital lending firms do seem to be headquartered in the Asia Pacific. And around 21% of payment firms actually are coming from sub-Saharan Africa. So we do have some concentrations. If we look at where, one of the things that we really pride ourselves at the center is that we always try to do globally comparative research. And so here we're going to start looking at, one of the key metrics that we are considering, which is that of transaction volumes. In this case, we're looking at the difference of transaction volumes between the first half of 2019 in comparison to the first half of 2020, and this is reported data from firms. Now, what's important to note is that we're not saying, for example, that fintech firms saw a value of 40%. This is not a comparative chart saying that MENA had more activity than, say, Europe or North America. But what we are noting here is that the firms that were headquartered in, say, MENA noted a much more substantive increase in their transaction level volumes. So it's just the one nuance that's important to note. So from a regional perspective, most regions are seeing growth in their transaction volumes in the first half of 2019. The only outlier really here being the United Kingdom, which actually sees a decline of around 3% on a year-on-year basis. And again, we're now doing a comparison here of, overarching region by region or significant geography against significant geography. When we look at this specifically at the Asia Pacific, where we've included India, we saw that India's overall market, and this is all of the different verticals that we noted in India, actually saw a slight increase of around 1%. Now, I know that 1% doesn't sound so significant, but actually the fact that you have such a prevalence of digital lending in the country, this is actually quite a remarkable and positive outcome. When we look at the different indicators, we look first at, again, market performance in terms of transaction volumes. So what we're doing here is comparing those transaction volumes now against those verticals. Now we've continued putting our verticals, by like lending, payments, capital raising, all the way through in the order of their largesse globally, so that we can really see, where these large impacts have come from. Overall, the global fintech market has grown in 12 of the 13 verticals, reporting year-on-year growth. So if we look at digital payments, for instance, this is where we're seeing a 21% increase in transaction volumes in the first part of the year. And this was in particularly noted, in MENA, in sub-Saharan Africa. We do note that there's an outlier, and that's very clearly digital lending, where we see a contraction of digital lending overall, where firms that were reporting indicated an overall decrease of around 8% in their transaction volumes. It is worth noting, however, that this performance is going to be quite dependent on your jurisdiction or your country. So we do see that some of the most dramatic drops reported are coming from the Asia Pacific, whereas if you recall earlier, MENA had a fairly high increase in their overall transaction volume changes. Now, in the case of places like MENA, we're starting off from a far lower fintech activity base. So that might help explain some of the things that we're seeing. If we hone in now just on India, and we're looking now at those top three verticals: digital lending firms, digital payment firms, and digital capital raising firms. And when we talk about digital lending firms, we're referring to, your peer-to-peer business lending models, your crowd lending models. When we're talking about digital capital raising, we're talking about your reward, donation, and equity crowdfunding models. What you see is that those debt-focused models, with respect to both volume and the number of transactions, actually does have a drop, 28% with respect to the volume, 29% with respect to transactions. Digital payments on balance stay around there for transaction volume around that 1% mark. And then you actually see a dramatic increase of around 42% in all of those digital capital raising activities. And this is quite significant. This is what helps us bring that average back over. And certainly we see similarly, an increase in the number of transactions. Now, interestingly, what we do note is that for digital payments and digital capital raising, we also saw a marked increase in the number of new customers that were coming onto these platforms, as well as a high proportion of retention of customers. So existing users that have come back to the platform to utilize that fintech service again. On the flip side, digital lending, we actually see a contraction of new borrowers. We see a contraction of repeat borrowers as well. Now, this is again not altogether that surprising, considering that we are in a pandemic. But what you really notice that where you have high levels of new users coming in, it really is marked how it is quite obviously correlated with higher levels or increased levels of transaction volume. Turning back now to a more global perspective, we looked at what we're referring to as the lockdown stringency metric. And what we're looking at here is how a fintech performed by the COVID-19 lockdown stringency within their specific country. So to determine this, we leveraged the Oxford COVID-19 Government Response Tracker. This tracker rates countries on lockdown measures that those countries are taking, and it accounts such factors as restrictions on mobility, school closing, any kind of government or policy mandated lockdown on the general public. We assigned each of our respondents with a corresponding rating from this Oxford stringency metric, and we created 3 equal quantiles for each of the fintech firms. So this is really allowing us to create a policy proxy for the severity of lockdown. Now, it's worth noting that India itself actually ranks in that high stringency arena. So when you're looking at this globally, India falls very much within that within the countries that fell into the high stringency. So what we see here is that the largest increases in transaction by both volume and number in markets with greater lockdown measures is higher. The higher the COVID-19 stringency, the higher the adoption of financial technology services. This increased adoption is not necessarily caused by the pandemic, but there certainly is a correlation between that stricter lockdown and that increased adoption of fintech services. And this trend is mostly consistent across all of the verticals. So not just lending, payments, and capital raising, but also insurtech, wealth tech, so on and so forth. What we note is that what we're trying to show here is that it's not to say that these firms are not facing challenges, but the fintechs that are in jurisdictions with stricter lockdown measures do have, you are seeing that actually there is a greater number of individuals that are utilizing these fintech services. And it is very likely that because so many of these fintech firms are frankly just inherently digitally enabled, they're well positioned to deal with the circumstances that come around a lockdown stringency. So what we are seeing is that these adoption rates suggest that fintechs are able to adapt and help their users transact in that digital environment when in-person activities is just not possible. And again, increased adoption it's not necessarily caused by the pandemic, but we do see this correlation for sure. We also looked at the differences between countries or jurisdictions that can be categorized as emerging markets and developing economies versus that of advanced economies. And in separating these advanced economies out with emerging markets or developing economies, we do see differences in the performance by transaction volume, as well as differences in the percentage of new customers, retention rates of existing customers. And I think here what we really note is that there's a clear story that EMDEs are having slightly higher transaction volumes, but they also have greater instances of customer acquisition, as well as markedly greater instances of retention or renewal of existing customers. And this theme of that customer engagement becomes very important as we look at the rest of the analysis and start to see, how different financial technology firms are reacting to their products and services, and certainly, what kind of regulatory needs they might have as well. So with that in mind, the fintechs that have responded to this study, and again, this is these 1,400 financial technology firms, they're fairly responsive when it comes to implementing changes to their existing products and services, and also to their terms and policies. And in fact, what we note is that just over 2/3 of the surveyed firms report making at least 2 or more changes to what we would refer to as their core offering. And this has been in a direct response to the pandemic. We also see that a further 30% of all of these firms are in the process of implementing a change. When we think of these retail-facing fintechs, and again, when we talk about retail-facing, we're looking at, fintech firms that are facing or providing services to households, consumers, MSMEs. These retail-facing fintechs, and in particular, the payment firms, the lending firms, the digital banking firms, are among some of the most nimble when it comes to implementing changes to their offering. What we saw here is that around 78% of these firms are actively making multiple changes. So you're going to see from this chart, we've presented key overarching changes that firms are undertaking, and that's the first sort of 4 columns is all fintechs. And then we also have a handful of additional changes that we see, but that are a little bit more vertical specific. So for example, deploying additional payment channels is very specific to digital payment platforms. You'll note suspension of new loan origination is going to be very specific to a digital lending or a digital banking firm. But when we look at the ones that affect everybody, these all fintechs, what we see is that there's a big emphasis on changes to qualification or onboarding. And this is quite important because this is really around that influx of new customers. It's not surprising that you're going to have an emphasis on onboarding and changes to criteria when you also are seeing this huge increase of customers coming to you. What we also noted is that actually around 50% of all digital lending firms are also actively making changes to how they qualify borrowers before they can actually make a transaction on that fintech firm's site. After qualification criteria, we see changes to the way that firms are positioning, their pricing. And this is really among one of the top tweaks. You can see that fee or commission reductions, payment easements, fee waivers, these are all being adjusted by at least a quarter of the different fintech firms that are responding to this study. Now, if we hone in specifically onto India, now we're looking at the top 3 verticals. So again, I'll just remind, that's the lending, the capital raising, the digital payments. And we see that this is not altogether that surprising, right? Onboarding is still the most important thing for these firms, but now we see they've made changes by about 50% of those firms have already come in and said, hey, no, we've made a change here. And then you see 8% that are doing this in progress. We also see an emphasis on payment easements, on payment holidays, really all of the things that are around the cost, right? The cost of using the platform. So there's a very big emphasis on making this more accessible for existing and potential customers, as well as thinking about, the most appropriate way of onboarding these new clients. Now, of course, it's wonderful to see fintech firms making adjustments to their existing portfolio, but it's also really important to think about how reactive fintech firms are becoming. So what we wanted to look at here is to understand the variety of the kind of new products, new services, the new features that firms are implementing when they're facing challenges that were presented to them by the pandemic. While we've seen firms very readily, pivoting existing activities, as we've seen in the previous slides, what we note here is that around 60% of all of the fintechs that responded to this study are also introducing a new product or service as well. So interestingly, what we see here is that value-added non-financial services is among the highest new category. And this is especially for firms that could be that are categorized as retail facing, and in particular, the lending and the payment firms. In this case, what we see is that fintech firms are introducing a variety of information-based services with an emphasis on financial education and literacy. And this is, again, particularly around the digital lending firms that are placing a very significant emphasis on that product category, especially when you look at all the other verticals that we looked at in the study. I'd like to give you an example, actually, of one of the firms that responded. They responded from India. It's a digital lending platform, peer-to-peer lending platform in India. They actually recently created an add-on portal that helps low-income female entrepreneurs understand the financial products that are being offered on that platform. And so you see a number of these additional value-added services. We also then note that there's other verticals that are, emphasizing other products. So for example, when we looked at digital capital raising, around 40% of all digital capital raising firms specifically had also hosted a COVID-19 specific funding or relief campaign. And this was really noted in those donation-based crowdfunding platforms. Okay. The second thing that you see here, is really the enhanced fraud and cybersecurity features. Now, I've kind of saved this discussion for last because it's arguably one of the most critical changes that we've seen at a global level, and one that has regulatory and policy making implications, as well as implications on the day-to-day operations of the firms. So this chart is telling us that just shy of 30% of all of the fintech firms that responded to this study have made an enhancement to their cybersecurity features, with a further 12% in the process of doing so. This is, again, particularly relevant for all of those retail-facing firms that are, whose customer is a consumer, a household, an MSME. And so while it's encouraging to see that there are a lot of firms that are focusing, it does kind of beg the question, is enough being done? And actually what we know is when we hone in just on India, we actually see that in terms of enhanced fraud and cybersecurity, this drops all the way to the bottom, with only 8% of firms having implemented this change, and 4%, going through the process of making a change like this. Where we do see a great emphasis of activity from Indian firms is around that disbursement of relief or assistance funding, and in particular from lending, but more so from digital payments. We also see an increase in insurance-related products for COVID-19. We see an increase in emergency working capital, and this is quite important because we see a very active peer-to-peer business lending environment emerging in India. In India, we've seen, a very big emphasis on those MSMEs, on supporting MSMEs as they go through their funding journey. And what we don't have. We're doing a study that looks at some of this in a more granular level now. But one of the nice things that we've noted over the last few years is that there has been a big emphasis on that business-focused lending, that business-focused debt activities. And so that kind of tracks with what we see as those new products and services that are coming from India. Now, when we think about, the government actors, government actors have responded to this pandemic with a myriad of policy measures. So to support the various COVID-19 related socioeconomic relief measures, FinTechs are playing an active role in the delivery or implementation partners. And we've seen that, again, in this previous slide, disbursement of COVID-19, very, very important in India. What we're looking at now is that this study wants to understand, the extent to which fintech firms are engaging in or supporting activities, or their willingness to do so. Now, at a global level, sadly, to date, there's limited involvement in fintechs in delivering COVID-19 related relief, despite a very high level of willingness by the firm. So more than a third of the fintechs reported a willingness to participate in delivery of one or more COVID-19 relief measures or schemes. So this is demonstrating a fairly strong interest despite low participation rates. Certainly, there are some high-profile examples of fintechs that do function as a delivery partner. Notably, you do see a select few lending firms that have issued loans, in the United States in the United Kingdom under the the United States under the SBA payroll protection plan. We also see in the United Kingdom the coronavirus business interruption loan scheme. Yet fewer than 10% of firms globally have had the ability to serve in a similar fashion. And really at a global level, only around 7% are MSME focused, only 6% are consumer focused. Now, low uptake from corresponding governments in positioning those fintechs as a delivery partner, it might relate to the fact that many governments just face, general supply issues. So it is maybe not a lack of wanting to utilize fintechs, but more a lack of capacity or resource to provide relief or stimulus funding. So it's important not to just say, oh no, governments are ignoring the fintech arena as a delivery partner, but we also need to think about the larger contextual situations within each country or each jurisdiction. Now, when we look at India specifically, when we've asked these firms, this top three, to really think about, okay, are you already actively engaging with NGO-led relief? Yes, 14%, 5% in discussion. And again, very heavily, we're willing across the board. You also see industry relief, you see, and you do see the delivery of government-based stimulus funding as well. So compared to the rest of the world, India is actually punching above the average. Generally. Certainly, fintech firms, they require assistance from their primary regulatory or supervisory relationship. And so in this report, we wanted to understand those key regulatory support mechanisms that fintech firms need in order to weather this pandemic. It's worth noting that many of the measures that are listed here, they're not fintech exclusive, but they're more generally applicable to financial services. And so in this context, we can begin to uncouple how financial technology firms are utilizing regulatory measures or interventions in the systems that they operate within. So when we look at the fintech responses in aggregate, and again, this is the full panel, we see that core regulatory activities relating to their customer or client onboarding are of paramount importance, with firms reporting the use of interventions related to, EKYC, with 17% of respondents, simplified customer due diligence, support for remote onboarding. Not surprising given the emphasis that we've already seen with respect to how they are adjusting their existing activities and with respect to the number of users that are coming onto a platform. So it's not surprising at all that actually there is a big uptake of focusing on that onboarding side, of focusing on that customer facing activities. But what we do note is that on balance, most fintech firms are not yet recipients of regulatory support. Now, there's caveats here and there where you see maybe digital payment firms in sub-Saharan Africa that have reported higher utilization. But on balance, actually, most fintech firms are in that we urgently need, or we need in the longer term, rather than being able to say, no, we're utilizing these support mechanisms already. So an urgent need for regulatory support is far more pronounced, with overall firms reporting urgent needs in authorization for new activities, followed by streamlining of products and services, and then of course anything really that's client facing. So that again, customer due diligence, support for remote onboarding. When we consider some of the additional nuances that are related to regulatory uptake, we found that, firms that were headquartered in, say, SSA, in MENA, in LAC, overall, these are, indicating more acute, urgent needs for additional regulatory support. Now, where India, and we're going to talk about India specifically in a moment, but where we see, some interesting trends is around that split between emerging markets and advanced markets. And what we see is that emerging markets tended to already utilize regulatory support more than firms in advanced economies. However, they also were reporting a markedly greater urgent need. So what we're seeing is that around half of all the firms in an EMDE country urgently need support, with particular emphasis on that authorization and streamlining of approvals. And lockdown stringency, and again, keeping in mind that India is a high lockdown stringency country, we see that lockdown stringency was another useful way to measure regulatory usage. For firms that are located in high stringency markets, they were reporting, at a higher level, already utilizing regulatory assistance, but also, again, around 45% of those firms are saying that they urgently need assistance in eKYC, in due diligence and onboarding. So you might have instances where there's greater uptake, but there's also a much greater need coming from, countries that are either EMDE or countries that are high lockdown. Now, if we look and we hone in specifically on India, it's the same story. You have a good uptake or good utilization already of key things like eKYC, due diligence, remote onboarding, but then you also have, over 50% of the panel saying that they urgently need or need in the longer term those customer facing things. And if we look at, streamlining products and services, extension of permissions, less burdensome reporting requirements, these are kind of above the average of the global. So there is a significant urgent need from those fintechs that are based in India, that really saying, to their regulator, to their supervisor, actually, we need help in order for us to weather this storm. So it's not just what the fintech can do for the public, but also what can government, what can regulators do to support these fintechs quite specifically? What is it that they need? Now, interventions that are related to regulatory innovation has captured the imagination of regulators, policymakers, and definitely researchers like myself. And so what we wanted to do is we wanted to seek to understand how governments might be able to enhance or enable that fintech ecosystem through things like, innovation offices, regulatory sandboxes, so on and so forth. And what we see here is that, we did another study in conjunction to this one, which was also with the Cambridge Center for Alternative Finance and with the World Bank. And in that study, we found that just shy of 40% of regulators were bringing forward fintech-specific interventions, but those were mostly as they related to an innovation office, to a sandbox, or to a hackathon. So when we consider the overall fintech environment, what we do see is that actually, by and large, retail-facing firms really are focusing more on those core activities, less so than than maybe a market provisioning firm like a digital identity platform or an enterprise technology firm. Nevertheless, when we look at those EMDEs versus advanced, this is where we do see, again, yes, a bit more activity with currently utilizing, but definitely an urgent need for sure. Now, this works out quite well because, in 2019, we had seen the first regulatory sandbox, in India, that was really focused on that retail payments theme. By November of 2021, the RBI decided to establish an innovation hub. So now we've seen the setting up of the governing council. We've seen, the sort of the initial policies. Although as far as we can tell as of right now, this has not become a fully operational innovation hub yet. Where we're noticing that this becomes quite important is that, there are a number of fintechs based that are headquartered or fully operational in India that do say, actually, hey, we do need assistance with a regulatory sandbox or with an innovation office. So that's not to detract from the importance of these kinds of innovation initiatives. I just want to really emphasize, though, that what firms really are actively needing right now, more so than innovation initiatives from their regulator, is those core regulatory activities. Okay. When we look at the different operational challenges, as these financial technology firms are dealing with day-to-day operational challenges, we really wanted to understand how firms were dealing with the endogenous and exogenous factors that are impacting their platform operability, their costs, and the associated operational risks. So in aggregate, and again, this is the entire data set here, In aggregate, we see that fintech firms are noting a slightly higher increase in things like platform downtime, agent downtime, number of unsuccessful transactions. But what's important to note here is that look at your differences between the low, the medium, and the high. Those firms that are in higher stringency areas actually saw an increase in their downtime, as opposed to firms in lower medium that actually saw a decline. So it's a little, you have to kind of sort of do the mental math here a little. But what you note is that actually firms that are in those high stringency arenas, they are seeing a handful of circumstances that have made their operations more difficult. Greater platform downtime, greater agent and partner downtime, greater number of unsuccessful transactions. And then certainly when it comes to key costs like data storage expenditure, onboarding expenditure, where actually for onboarding expenditure, it's almost double that, or it is double that of low or medium stringency countries. And this is again, where places, where we're seeing, these firms putting quite having to spend quite a bit more. And then the last, of course, is that of cybersecurity risk. And here what we're seeing is that firms that are in those higher stringency places do see a slightly across the board, we see that cybersecurity risk has increased markedly. But we also then note that this is less strongly felt in low stringency and more so in medium or high. Now, an increase of 17% in your perceived cybersecurity risk is substantial. And this tracks very well with what we've seen regulators being really concerned about. In fact, we saw from our regulatory study that, sort of 3/4 of all regulators are very concerned around cybersecurity issues with financial technology firms. And then when you look at how these firms are now looking at cybersecurity as it has impacted their own companies or their own operations, it tracks very much with what regulators are seeing as well. Now, if we look specifically at our models from India, what we actually see is that downtime has not really been too much of an issue, actually. Firms have been able to see, at the platform downtime has actually not been as bad. And this is in particular for those capital raising firms where they've actually seen their platform downtime. Again, so this -10 is really almost like a increase by 10% rather than a drop. However, their agent or partner downtime, so their ability to rely on their service providers or their vendors has increased, and this has been increased significantly for payment firms. And for payment firms, we also see that there's been a very big increase in that number of unsuccessful queries, transactions, or access requests. Now, when we think about onboarding expenditure, we saw that actually onboarding expenditure dropped for digital lending platforms, but keep in mind that they also really shrunk their new borrowers or existing borrowers. On the flip side, you look at capital raising and digital payments, and this is where we see a market increase. And then everyone across the board saw an increase in their data storage costs, and then quite critically, cybersecurity. Cybersecurity is an area where that cybersecurity risk has increased. As we kind of come to the end of my presentation, in general, financial technology firms globally are reporting, downward revisions of their fiscal year turnover. In this case, globally, it's a downward revision of around 4%. Firms in advanced economies have revised this target down by 7%. However, firms in emerging markets have only reported around a 1% decline. Now, keep in mind that this is going to be different for the different verticals. So if you look at the sort of bottom right hand of the screen, what you see is that for digital lending firms, they are saying actually our annual turnover has decreased substantially. This also is in parallel with what we've noted around their capital reserves, where these firms have indicated that their capital reserves have also been impacted quite negatively as a result of the pandemic. Now, on the flip side, though, we look at digital capital raising and digital payments, and we actually see that here's where you actually see a revision upwards of 5% for capital raising, 8% for payments. And when it came to the number of full-time equivalent employees, we see a drop in the digital lending firms, but we see an increase in payments, and we see a slight increase in digital capital raising. If we look at the lockdown stringency, here's where you see, in particular places that have those low stringency countries, they've revised down quite a lot, whereas actually high stringency markets overall, and keep in mind we're talking about all fintech verticals here, have really been able to sort of maintain their fiscal turnovers against the previous year, or they've not had to do too much revising of their turnover targets. However, what we really note is that firms that are based in high lockdown stringency jurisdictions, they have actually really added a number of employees to their operations. So, I'd be remiss to say that, when you look at this, it's kind of like, well, what does this all mean? Are fintechs doing well? Are fintechs doing badly? I think what we can really say is that this is a mixed bag. The fintech ecosystem is growing fairly rapidly as a result of COVID. We see this because you see this influx of new employees coming on. It's one of the few markets where actually where there are furloughs, but actually we're seeing that there's growth. However, certainly, even though you have a number of new customers, even though you have greater retention of your customers, the costs, those operational costs have increased substantially. Cybersecurity costs have increased. Expenditures around your onboarding, expenditures around your data storage, those things have increased as well, markedly. And so this really can impact that fiscal turnover targets. And when we look more broadly, at capital reserves or their fundraising outlook, when we think about their financial positioning, despite seeing increases in, the high stringency places or specific verticals in, say, India, we're still seeing that, rising operational costs are impacting those firms' profitability, and that actually the pandemic has negatively impacted capital reserves. Around 21% of firms globally were saying that this has been a significantly negative impact. 40% of firms have indicated that they feel their current valuation has declined significantly as a result of COVID-19, and a further third of all firms have indicated that they feel that their ability to fundraise in the future has been negatively impacted by COVID-19. So although we've seen a lot of opportunities, we've seen a lot of these fintechs, and in particular in India, these fintechs being able to react to the COVID-19 pandemic in a way that they can service their clients better and more easily, it has also been a hardship in many ways. And so it's very important not to just think of the opportunities, but also some of those critical challenges, and where government and where policymakers and where regulators in particular can help those fintechs weather the storm. So as I know I've gone over a little bit, so if you can just indulge me for 90 more seconds, I do want to invite digital lending and digital capital raising platforms to participate in our current study that is ongoing. So on an annual basis, the Cambridge Center for Alternative Finance conducts a time series transaction level project that looks at those lending firms, capital raising firms, so peer-to-peer lending, crowdfunding firms, where we try to understand, how at a more granular level, those two verticals have changed. So we are currently collecting data for 2019 and 2020. We felt that it would be relevant to collect the two together because obviously from one year to another, COVID has created a market change, and you can't really talk about one without the other. For some of you that might be familiar with our research already, we've actually been running this program for coming on to 6 years. So we have data going all the way back to 2011 in some cases, but mostly 2013. So if you are a digital lending platform or a digital capital raising platform, I really urge you to come to this site, to our link, to please, contribute 20 minutes, participate in this study. Your responses are fully anonymized and aggregated, but it's quite critical because it's an evidence base of information that not only allows us to really understand what's happening in your specific country, but how it compares globally. And it is a meaningful public resource. So with that, with that in mind, thank you so much for the time. I know I've gone over, so I apologize.